freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here again, and as always, with the amazing Adam Penn. Adam,
you're really going for the intros today, aren't you, bud?
I know. I'm trying to build you up. I feel like you need that. Everybody needs a little bit of that, like, hype man in their life. So yeah. I'm happy to be able to be here.
I appreciate it.
Yeah. Well,
I'm doing great today, Dustin. Enjoying it's 5:30 my time. We started this call at 3:30.
3:30 your time, yeah.
So it's been 2 hours. We've recorded one 15-minute podcast so far and have chatted about airplanes, raising money, businesses, houses, all sorts of things.
Yep.
But now it's time to record another podcast.
That's just the way it goes sometimes. And this is after we actually saw each other in person for a few days.
Yeah,
not too long ago. So.
Just in Dallas at the Limitless conference.
Yeah. Well, I figured that's enough banter for all the folks who've provided us feedback that we should have more banter at the beginning of our episodes. I think we've checked that box. So
I don't think it works when we say we've checked the box, but continue.
No, you feel like it has to be more organic,
natural
banter?
Yeah.
Oh, okay. I got you.
Well, continue.
Well, it's like scripted television, right? It's like Top Gear. Everyone got like frustrated that like, oh, Top Gear is scripted, and they're whatever. This is what this is. It's just scripted banter. It's fine. Okay. It's good for everyone. All right, moving on. You had a topic, I think, when we were talking about or we were kicking around some ideas for this episode, and I'll let you tee it up and kind of kick that one off then.
Yeah, I think we were going to talk about deals not performing, right? And there's different levels of deals not performing. We've seen, I don't think we'll mention the names of the people, but we've seen deals that there's $0 coming back, like full capital loss. I mean, I'll mention my name. I've had a deal that happened on, but we'll leave other names out of it. And then there's deals that are like, I'm not getting my cash flow, right? And then, funny enough, I think the people who lose 100% of their equity are less annoyed, maybe not like truly annoyed, but less annoyed than the people who are like, this deal's not performing, right? I'm getting 2%. I'm supposed to be getting 6%. I don't know that this was the path I was trying to go down here, but at some point you just accept that, okay, I lost my money, right? Like I've lost money in crypto stuff and things where you learn, right? Yeah. And, investing in my own portfolio, we never want to learn with other people's money, but things happen, right? And then there's the people who are like, it's a constant reminder, like, hey, this deal update, we're still a little bit behind, or this has happened, that has happened. And so really, I think what I wanted to talk through was essentially that this is a reality of life, right? Things happen. People invest in stock markets and the market changes, right? You can call your financial advisor and be annoyed about it, but, at the end of the day, it's, what are we going to do to recover from it? And I think really maybe where the back of my mind was going on this context was just, if you're investing in a deal, let's say it's not performing, well, what are the safety nets that kind of keep you in a decent spot, right? Because there's non-performing and then there's losing equity, and you could be losing equity to inflation, all those other things. But we've got a deal in Memphis where we bought some fourplexes, and they're doing okay. We're cash flowing. We're not cash flowing great. The market really dove off, but we've got, for the most part, 30-year fixed debt on the whole portfolio. So even one with a totally messed up, where the construction project was way over budget that we've now, started to bring back on the line. It wasn't like we had a bridge loan that was expiring in 6 months. And so I think maybe my point here is that when you analyze deals, like, don't automatically go to what is everything that can go wrong, but like, where are our safety nets, right? What are the ways that this can be saved should something bad happen? We just closed on a 20-unit building in Chico, and it was a 5-year fixed note. And I was like, talking to some investors, and we're like, okay, well, after 5 years, we got to go get another note, right? And that was new to some people who had only been in single family. What does that mean, right? Like in 5 years, I'm forced to go get a new note. And when we actually got the terms from the bank, the final terms, it was 5-year fixed and then 5-year variable with no prepayment after 5 years. So I just, all of a sudden, there was 5 more years on this note that were not on this crunched timeline. Obviously, the rate's going to go variable, but that's another safety net. We didn't know we are going to have that walking into the deal, but it's another thing that's going to protect us at year 5. We don't have this, 3Ds, debt, death, and divorce are going to be the reasons deals trade.
Yeah.
So that was a little of everything, but I'm not sure if there's a direction in that. Those are my loose thoughts. Is there a direction in there that you want to drive that?
No, I mean, I think there were several things that went through my head as you were talking. I think the first was that, I mean, obviously you never ever want to lose money, but if you, we don't just have, like, there's the line that's in every single thing you'll ever see about investing. It's in every PPM. Like, there's risk involved, including risk of full capital loss. And I think some people read over that and think, okay, well, whatever. But there's risk in all investing. Like, unless you're just have cash in FDIC insured savings accounts and you're buying T-bills, like,
which there's still theoretical risk.
Yes, exactly. And inflation risk, right? I mean, is inflation going to be higher than that? So, like, there's risk in everything. There's always going to be risk, and I think you can't, like, you have to, like, accept that first. Like, and I actually wrote on this in the newsletter recently about, like,
a newsletter.
I do have a newsletter. Yes, passiveperspectives.com. If you're not signed up, go sign up for the for the newsletter there. I think some people just refuse to accept the idea that they could possibly lose money. And you kind of have to go into anything. Obviously, you don't want it to happen, but you need to ask that question. And you talked about, defenses and some things like that. And I think, obviously there's some things specific to the deal, and you want to know some ways that the deal has been de-risked and can do that. But first and foremost, if you're a passive investor, you can't get out over your own skis and be investing more money than you can stand to lose. I mean, that position sizing is far and away the most important risk management element out there.
And I would say, even if you can afford to lose half your net worth, it shouldn't all go into one deal.
That's exactly right. And so even if it's like a sure thing and it's, super low risk, I've had conversations with investors of ours, like into some of like the credit fund, which is, I think, of overall a lower risk investment. But, I had one investor we were talking to about it, and he was like, well, I can put X amount of dollars. And I'm like, why don't you? That's fine. You can do that. And this is your decision. But I pull back and, like, make sure that this is a number you're comfortable with. And if that were to go to zero, that you're still going to live your life, right? You're not going to have to sell your house. You're not going to be out on the street.
Well, and part of that is,
I think that's something, and especially in a more frothy environment, you're not seeing this as much now, but at the top of cycles, right? Like what we saw in 2020, 2021, early 2022, you got to be really careful about this, because you and I both know people who invested way more money than they ever should have in things that turned out to be a Ponzi scheme, like a true
mortgage to their houses to do it. Correct.
And it was a full on Ponzi scheme. And so, obviously that's bad, but we know it's obviously, I mean, completely like the worst, right? But at the same time, like we both know people who put way more than they should have, and it's very negatively impacted their life. And others who might have put the same amount in, but relative to their overall net worth, it was a much smaller percentage. And they're like, yeah, this sucks, but okay, like I should have known better. We just move, like, this seemed too good to be true. I should have known. We just move on. And so that's something obviously that's very personal to everybody, right? Like you have to look at your own portfolio, your own net worth, the composition of all of it, and know that in any individual investment, you should never invest anything more than you can afford to lose. And I think that's probably the first thing when we start talking about loss and risk and things like that. Like you have, regardless of the details of the deal, you've got to you have full control over how much of your own money you're putting into a deal, and that's good or bad. That's a very big lever for what your life looks like, depending on how that deal goes. And so if there's knowing that there's risk in all investing, and there's a possibility this thing could go to zero, you have to know, okay, if that happened, what's my life look like? And am I okay with that? And am I still going to be able to put food on the table?
And I think one thing that kind of pairs along with that is if you, when you're thinking about the risk of an individual deal, if it starts as a cash flowing deal versus like an appreciation play, right? Then let's just say you're buying a deal and it's making 3% cash on cash return. That's the pro forma right out of the gate, which is year one pro forma is probably pretty freaking accurate. There's not a whole lot that's going to change in year one, right? You're going off of actuals. And so, maybe year three, they're not going to hit the target, but let's say year three was 12%, right? They had some magic value add they're going to do. Well, they might not hit all that within 3 years, but in year one, they'll probably be at 3%. So that's probably a safe. Maybe they draw down to 2, an expense goes out of line or something. And so the year three, they can kind of push it up to 4. But you're in a safer position than being like, we're buying this deal and it's negative 5%, but by golly, by year 5, we're going to be up to 12, right? Like if -5 slips to -6 or -7, and now you're drawn into reserves, right? Like it's a totally different conversation.
Yeah, for sure. I think the other thing that originally came to mind when you were talking earlier, I had a conversation recently with another fairly big GP. They've got several thousand apartment units.
That's big.
What's that?
That's big.
It's decently big.
Yeah.
Not someone that's a household name by any means, but has been very successful in real estate. We were talking about kind of the environment online and particularly Twitter. And there's kind of this thought that I see often where folks will go around and they'll say it's a very much holier than thou kind of attitude, where it's like you've got other GPs that are like, I've never lost investor money, and you should never ever invest with anyone that's ever lost a dime of anyone's money. And those people are terrible. And if you ever lose investor money, you should never be in this game again. And you should just be shunned, and no one should ever do business with you. And I see that attitude a lot online. I wonder, I'm sure some of it's true. I'm sure some people are just doing it for like rage baiting for the engagement, right? But at the same time, I see it more than I would expect. So I imagine that sentiment's kind of prevalent. And I disagree with it. And I'm not saying you should go out and just, someone's lost a bunch of money, so you shouldn't like question anything. But I don't feel like it just doesn't seem like it's a disqualifying thing to me, right? Like I think you're expecting for people who are in the business of investing to always bat 1,000. Like
it doesn't happen.
It just doesn't add up. And I think you'll be hard pressed to find someone that has been, multiple decades that's never had a deal that went bad on, or, even if it not like a total capital loss, but partial loss, or it significantly underperformed projections, right? Like that's, again, it goes back to the fact that there is risk here, and you obviously do things, and you look at as a passive investor, you look at the deals, you look at sponsors. It's a great question to ask. Have you ever lost money before? And if they say yes, it's like, okay, well, what happened? What did you learn? What changes have you made as a result of that experience?
I've talked to very successful people who say that I will never invest with someone who hasn't had a deal go bad. Doesn't mean that they've lost all the money, but like, tell me about a deal that went bad and how you handled it. Oh, I've never had a deal go bad. Then you don't know what you're going to do when that happens. I don't want to invest with you.
Yep. And that's the thing. I'm glad you brought that up, because that's always the other side of the whole, you should never invest with someone that's lost money. It's like, okay, well, how do you now you really got to gauge this, a sponsor's ability to handle hard times. Like how have they navigated a challenging situation? And it doesn't mean that you have to lose money to have had that, but that's a pretty good it's a pretty good indicator of experience, right? And so again, for passive investors, I've written about this before. You just ask the questions, find out, understand what's going on, but also like don't have completely unreasonable. I think that's also tied to this like unreasonable expectation of there's no risk associated with the deal, or there's not like we're not going to lose money. Well, I've invested with a sponsor that's never lost money. Well, that doesn't mean that like that could be their first deal that goes south, right? So you still like, even that is not this like perfect indicator. So like you just have to know, and I see this with some newer investors who tend to have more conservative type portfolios that don't want to take a lot of risk. And okay, well, then you're just not going to get the returns. We talk about all the magical things that we love about real estate and the cash flow and the appreciation and tax benefits. It involves risk. And again, that's not to say that you're out here YOLOing into the next random thing that comes up, but you have to be okay with taking that step into an arena that could involve loss of capital. And if you're not, then you just got to stick to T-bills, right? Like, listen to what we talk about, but you have to expose yourself to some level of risk and at least mentally be prepared
or invest in a credit fund, which is, I think, very safe. Someone asked me the other day what the biggest risk is, and I said, I think it's lack of liquidity, right? You're locked up for 2 years. Outside of that, I think, anything is possible, but I think it's a fairly safe deal. You're essentially the lender. There's space on top of you that if even the property gets worth less, your equity position doesn't get hit first.
Yep. Yeah. I mean, I think that deal is a good example of a lot of things, of macro trends, of pieces within the deal, of underwriting, of things that are done to de-risk a deal, but it's not without risk. I mean,
another risk is that you're not going to get some crazy upside if the market goes crazy.
Very true.
You put certain hedges in place, and that prevents the upside.
Yep. That's exactly right. I look forward to, looking at the transcript of this podcast and seeing how many times we've used the word risk. I think that's
what risk?
Maybe that should, yeah, exactly. Maybe that should just be the title of this.
Is there a risk that we've said the word risk too many times? Is it risky?
Of course, Adam. There is risk in all investing, including risk of full capital loss. You should read your PPMs more often. No, I mean, I feel like we're kind of circling around this one a little bit, but like that's again, I wrote about this recently. The first step in some of this is just realizing and being able to acknowledge and accepting, if I'm going to invest in things that are going to give me a decent return, I have to accept some level of risk. I can do things to reduce that, but real estate's not T-bills, right? Like there's not a government guarantee here that the cash flow is going to continue to stay, and that the sponsor doesn't use bad debt and significantly underestimate their expenses and things like that. So you gotta do your due diligence, but know that the reward for that are these higher returns. So it's okay. Like, just be willing to accept some risk. And maybe this is me talking to myself from like 20 years ago when I was like, I don't want to. And I know plenty of people who are hesitant to take this risk because the thought of losing money is just so terrifying. But if you want the upside, you've got to open yourself up to the possibility of that downside.
I'll throw it out there for the first person that emails us and tells us the number of times we've said risk in this podcast. They'll get a Bidwell Capital pen. They're very nice. It's like a $40 pen. They're great. Email us. Tell us how many times we've said risk. The person that gets it closest to right will get a free pen. I
like that. Should they fill it? No, send an email to risk@wealthindependencepod.com and let us know how many times we said risk. Yep. It'd be great. I don't know, Adam, this is that, like I said, I think we're kind of circling around this one. Any other parting thoughts on this?
No, if people got questions, reach out. We're always happy to have a conversation. And I think the easiest way to start understanding risk is to look at deals and try to look at them from a risk lens and see where, you see the potential problems could be. With that being said, once again, if you send us an email with a guess for the pen competition, we'll happily send you back any of the deals that we're doing, tell you about them. You can tell us where you see risk in them.
Absolutely. No, that sounds great. And while you're at it, we always have to throw in, if you are enjoying this and you enjoy podcasts that say a particular word a ridiculous amount of times, give us a thumbs up, give us a like, 5-star rating if you're listening on Apple Podcast, like and subscribe on YouTube. Do the things that help the algorithms know that we're providing value here. You're enjoying what you're hearing, and we can get this in front of more people. We would very much appreciate that. But Adam, if you don't have anything else, we will get on out of here for this one. All right. Sounds good. Well, everybody, we appreciate you joining. As always, again, feel free to write in with questions or comments or anything like that. We always appreciate it. But we will catch you on the next one. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.